When a bank that spent years pushing an asset down suddenly becomes one of its biggest physical holders, that's not a coincidence. It's not a philosophical shift. It is a signal that the end game is approaching. In the final weeks of 2024, while most investors were distracted by holiday spending and year-end market recaps, one of the most important moves in the silver market in over a decade unfolded quietly inside U.S. exchange vaults. Public data from the COMEX warehouse revealed that JPMorgan Chase transferred approximately 47 million ounces of physical silver into its eligible inventory. Before this, the bank held just over 12 million ounces. Afterward, its total shot up to nearly 60 million. This wasn't a routine adjustment or a speculative trade. It was the largest single accumulation by a commercial bank since the 2011 silver squeeze. And it happened at a moment when mainstream commentary insisted that silver demand was soft and unremarkable. That contradiction is the first red flag. Institutions do not quietly deploy capital at this scale while publicly dismissing the asset unless they are deliberately taking advantage of a mispriced narrative. JPMorgan didn't buy futures contracts or expand derivatives exposure. They took delivery of physical metal and placed it into vaults under their control. That distinction matters. Paper exposure can be exited instantly. Physical accumulation cannot. It reflects long-term positioning. To grasp the magnitude of this move, 47 million ounces represents roughly 6% of the entire world's annual silver mine production. If a single institution quietly acquired 6% of the world's annual oil supply or wheat harvest, it would dominate financial news for weeks. In silver, it passed almost completely unnoticed. That silence is not accidental. Quiet accumulation depends on sellers remaining uninformed. This behavior follows a well-established institutional playbook. When banks want to sell an asset, they promote it. When they want to accumulate, they suppress attention. In 2020, gold was accumulated loudly. Analysts upgraded targets, and retail enthusiasm was encouraged so institutions could sell into strength. Silver in late 2024 followed the exact opposite pattern. No upgrades, no excitement. Just raw warehouse data revealing a massive shift in ownership. The type of inventory JPMorgan chose deepens the signal. COMEX warehouses classify silver as either registered or eligible. Registered silver is available for delivery against futures contracts and supports the paper market. Eligible silver is privately owned metal stored in the same vaults but not committed to delivery. When JPMorgan moved tens of millions of ounces into eligible status, they effectively pulled that silver out of the supply-backing futures contracts. In practical terms, the bank said, "This metal is not supporting paper liquidity. It belongs to us, and it is staying put." This decision is especially revealing given JPMorgan's history. Over the past decade, the bank paid nearly $1 billion in fines related to precious metals manipulation. Traders were convicted for spoofing, placing fake sell orders to drive prices down before canceling them. JPMorgan was not a passive observer in the silver market. It was actively shaping its price. Now, that same institution is no longer leaning on the market. It's accumulating. When the house stops rigging the game and starts placing bets alongside the players, it signals that the game itself is approaching its conclusion. But JPMorgan's move is only one piece of a much larger picture. At nearly the same time, something equally significant occurred across the Pacific. In December 2024, China, AOS State Administration of Foreign Exchange, disclosed a sharp increase in precious metals purchases during the fourth quarter. Total acquisitions reached approximately $8.2 billion, a more than threefold increase from the previous quarter. At average prices during that period, this implies potential purchases exceeding 200 million ounces across all metals. Simultaneously, China reduced its holdings of U.S. Treasury securities by more than $50 billion. This wasn't routine diversification. It was a clear rotation away from dollar-denominated paper assets and toward tangible reserves. Sovereign buyers don't speculate on short-term price movements. They prepare for structural change. When nations shift capital this way, they are responding to risks embedded in the global monetary system itself. The third confirmation appeared in the ETF market. During November and December 2024, the largest silver exchange traded fund saw outflows of roughly 22 million ounces. Investors were selling their paper silver exposure. Under normal circumstances, that much selling pressure would drive prices lower, but it didn't. The spot price of silver remained remarkably stable. That stability tells us something critical. Someone else was absorbing every ounce being sold without forcing the price down. Not retail traders, not momentum funds. It was buyers who needed the physical metal and were willing to accumulate it regardless of short-term price moves. This is classic accumulation behavior. Weak hands exit, strong hands absorb. When prices remain firm despite significant ETF outflows, it signals a transfer of ownership from uninformed sellers to informed buyers. It is one of the clearest early warnings of an approaching repricing. The timing connects all of these events. JPMorgan completed its accumulation in mid-December. China disclosed its purchases days later. And on January 1st, 2025, Basel III regulations fully took effect for U.S. banks. These rules fundamentally alter how precious metals are treated on bank balance sheets. Under the old framework, banks could operate with extreme leverage, holding only fractional physical backing for huge unallocated metal positions. Basel III penalizes this structure. Unallocated precious metals now carry capital charges unless they are physically allocated. In effect, banks must either secure real metal or accept reduced profitability. JP Morgan didn't wait. They allocated ahead of enforcement. Other banks will be forced to follow, but they will be competing for a physical supply that has already been drastically reduced. This is the regulatory forcing function. Paper leverage must reconcile with physical reality. And that physical reality is this: there is not enough silver to support current paper claims at existing prices. Let's look at the fundamentals. Global silver mine production in 2024 declined slightly to around 820 million ounces, but industrial demand reached record levels, exceeding 650 million ounces. Solar panel manufacturing, electric vehicles, grid infrastructure, and defense electronics all increased their silver usage significantly. Before any investment demand is even counted, the market already shows a substantial supply gap. Add in coins, bars, institutional accumulation, and sovereign buying, and the deficit becomes structural. This is not a cyclical shortfall that resolves during a slowdown. Government mandates for energy transition and defense spending lock in this demand, regardless of economic cycles. On the supply side, the constraints are severe. Roughly 70% of all silver is a byproduct of mining other metals like copper, lead, and zinc. This means higher silver prices alone cannot rapidly increase output. Political risk in key producing regions, especially Latin America, adds further uncertainty. It takes years to develop new mines, and existing ore grades are declining, requiring more energy and capital just to produce the same amount of metal. This is why institutions are moving now. They aren't reacting to headlines. They are responding to simple math. History offers a useful comparison. In early 2011, silver rocketed from the mid-20s to nearly $50 in a matter of months when physical demand collided with paper leverage. But today's setup is arguably more extreme. Paper to physical leverage is higher, industrial demand is larger, sovereign buyers are active participants, and now regulatory pressure is forcing physical allocation. Delivery data already reflects this stress. December 2024 saw delivery requests far above historical norms, with traders demanding physical metal instead of cash settlement. That behavior only appears when confidence in paper pricing erodes. Meanwhile, physical silver is migrating geographically. Western vaults report steady declines, while Eastern exchanges record historically high withdrawals. Silver is moving from financialized Western markets into regions that treat it as strategic wealth. Once it leaves, it rarely returns. So what does this imply for the price? The silver market is small relative to global capital. Total above-ground investment silver is measured in tens of billions, not trillions. Even modest institutional allocations can overwhelm the available supply. The gold-to-silver ratio remains elevated compared to long-term norms. Historically, when physical shortages emerge, that ratio doesn't compress gradually, it snaps rapidly. Silver doesn't ease into a revaluation, it leaps higher when the market is forced to reconcile. Volatility is unavoidable. What matters most is that institutional behavior already confirms the expectation of much higher prices. JP Morgan's move was not speculative, it was defensive positioning. For investors, the distinction between paper and physical exposure becomes critical. Paper instruments offer convenience but rely on system stability. Physical ownership removes that counterparty risk. This doesn't require panic or blind speculation. It requires awareness. The signals are visible, documented in public data for those willing to look beyond the headlines. JP Morgan showed its hand. China confirmed the direction. ETF flows revealed the transfer. Regulations are enforcing the next phase. The question is not whether silver will reprice, but who is positioned before that repricing becomes obvious. The math is already in motion. The timing, based on regulation, demand, and physical limits, points to months rather than years. Silver doesn't need belief. It needs a reconciliation between paper promises and physical reality. And that reconciliation has already begun. Thanks for watching. If you found this information valuable, be sure to subscribe and hit that notification bell so you don't miss our next update. See you next time.